What would make investors accept a profitable bank trading at roughly 35 centavos for every peso of book value? In EastWest's case, the market is questioning how dependable that book value really is. It is also asking how much more credit trouble may still be ahead. At a recent price near 11 pesos, EastWest had a market value of approximately 25 billion pesos. Shareholders' equity stood at about 81.7 billion pesos. That places the stock at roughly 0.31 times reported book value. It trades at approximately 0.35 times tangible book value, depending on the price and accounting definition used. The latest annual dividend of 82 centavos per share implies a yield of approximately 7.4%. That combination is striking: a profitable bank, a deep discount to book value, and a high dividend yield. But in banking, a low price-to-book ratio is rarely just a gift. It is usually the market's estimate of risk. EastWest's latest results show why investors remain cautious. For the first half of 2026, EastWest earned about 3.4 billion pesos. That was down 17% from the same period a year earlier. Yet the underlying operating figures were much stronger than the headline profit number suggests. Net revenue increased 19% to 28.4 billion pesos. Net interest income rose 21% to 23.1 billion pesos. Pre-provision operating profit climbed roughly 30% to 14.4 billion pesos. The cost-to-income ratio improved to 49.3%. The core engine was not failing. Revenue was growing, margins were strong, and efficiency was improving. The problem was the provision line. EastWest set aside approximately 10.1 billion pesos for probable credit losses during the first half. That was about 66% higher than a year earlier. It was nearly 3 times the bank's reported net income for the period. Second quarter provisions alone reached about 5.3 billion pesos. They helped drive a 32% decline in quarterly profit. Management called the reserve buildup a prudent response to credit conditions and economic uncertainty. Investors must ask whether losses are being recognized early, or weakness is still hidden in reported loans. The question matters because EastWest is heavily exposed to consumer credit. Consumer loans totaled approximately 331 billion pesos at the end of June. They represented nearly 85% of gross customer loans. Credit cards and teachers' loans were among the main sources of growth. These products can generate attractive yields, but losses can become volatile when household finances weaken. That is the central tension. The portfolio supports high margins while increasing credit risk. EastWest's filing does not provide a conventional June gross non-performing loan ratio. Its loan aging schedule shows approximately 11.5 billion pesos, more than 90 days past due. That implies a rough delinquency ratio between 2.8 and 3%. That is not a distress level figure, but it appears above the 2.45% ratio for Philippine universal banks. Earlier investor materials placed EastWest's consumer NPL ratio at about 4.5% for 2025. The real uncertainty is whether provisions have reached their high-water mark. The allowance for credit and impairment losses rose to 18.4 billion pesos from 14.4 billion. That reserve equals about 160% of loans, more than 90 days overdue. The increase could reflect early loss recognition or weaker recent consumer loan vintages. Book value itself deserves scrutiny. EastWest reported equity of approximately 36 pesos and 31 centavos per share. Goodwill and other intangible assets totaled about 8.5 billion pesos. Removing them results in tangible book value of roughly 32 pesos and 52 centavos per share. At a share price near 11 pesos, the stock trades at about 0.34 times tangible book. Amortized cost securities carried a value of 120.9 billion pesos versus a fair value of 113.7 billion. Marking those securities to market would reduce adjusted tangible book value to approximately 29 pesos and 33 centavos per share. Even then, a price near 11 pesos would equal only about 0.38 times adjusted tangible value. The securities gap explains part of the discount, but not all of it. Funding provides another reason for caution. Deposits increased to roughly 472.9 billion pesos. But time deposits surged 41%, while demand deposits declined. The current and savings account ratio fell to 76% from 82%. That suggests greater reliance on more expensive funding. Bills, acceptances, and repurchase borrowings also expanded. EastWest still benefits from a net interest margin of around 8.5%. But higher funding costs could gradually reduce that advantage. Now consider the other side of the argument. EastWest absorbed 10.1 billion pesos in provisions and still produced 3.4 billion pesos in profit. Before provisions, the bank generated 14.4 billion pesos in operating profit. If credit costs stabilize, that enlarged earnings base could flow through quickly to shareholders. The bank would not need dramatic loan growth. It would need the deterioration to slow. Management has indicated plans to shift growth toward more secured asset classes. The bank is also investing in digital banking, data, and risk management. Those efforts will not eliminate credit risk, but they could reduce earnings volatility. Capital is another source of support. EastWest reported a capital adequacy ratio of 12.5%. The Common Equity Tier 1 ratio was 11.7%. Both were above regulatory minimums, even after the May dividend. The buffers do not make a prolonged loss cycle irrelevant. But they do not suggest a bank approaching a solvency event. Deposits were also 15% higher than a year earlier. Then there is the dividend. EastWest declared 82 centavos per share after reporting record 2025 profit of approximately 9.2 billion pesos. The payout rose from 54 centavos in 2024 and 41 centavos in 2023. At a share price of 11 pesos and 8 centavos, that equals about a 7.4% yield. It is a trailing, once-a-year distribution, not a guaranteed forward payment. Still, the payout appears covered by current earnings. EastWest earned approximately 1 peso and 52 centavos per share during the first half alone. If second-half earnings matched the first half, full-year earnings would approach 3 pesos and 4 centavos per share. That would put the 82 centavo dividend at a payout ratio of roughly 27%. The immediate constraint may be capital, future credit losses, and management's willingness to distribute cash. The dividend also matters to the Goshen family's Philinvest Group. The group directly owns 40% of EastWest and another 37.9% through FDC Forex Corp. The effective stake is therefore approximately 77.9%. The EastWest distribution represents about 1.44 billion pesos attributable to the group. That makes EastWest the largest identifiable cash dividend contributor among the group's listed subsidiaries. Banking and financial services contributed about 7 billion pesos, or 40%, of the group's 2025 bottom line. EastWest is a source of earnings, dividends, and holding company liquidity. That alignment offers reassurance, but it is not an unconditional safeguard. If consumer credit losses accelerate, retaining capital could matter more than defending the current payout. What would a recovery look like for shareholders? EastWest does not need to trade at book value for investors to earn an attractive return. A re-rating to 0.45 times June tangible book value would imply a price near 14 pesos and 60 centavos. That is roughly 1/3 above a price near 11 pesos, before dividends. But that potential is conditional. The market is pricing a consumer-heavy loan portfolio, while provisions are surging and funding is becoming more expensive. Asset quality disclosure also remains incomplete. A 7.4% yield can disappear quickly if the dividend is reduced, or the share price falls further. For investors who believe provisions are close to peaking, EastWest may look unusually cheap. They are being paid to wait for credit normalization, supported by strong margins and improving efficiency. For investors expecting a longer consumer credit reckoning, the low multiple is less an invitation than a warning. EastWest at roughly 0.35 times book value may be a bargain. But only if book value is sound, reserves are sufficient, funding pressure remains manageable, and the dividend survives. The decision is not whether EastWest is cheap, but whether it is cheap enough for the risks beneath the headline numbers.